Good afternoon. Thank you all for being here. We appreciate seeing you. My name is Andrew Eastman. I'm an attorney in Husch Blackwell's Energy and Natural Resources Group. Before we start, let me cover a couple of housekeeping items. At the bottom of your audience console, there are multiple application icons for your use during the program today. If you have any questions during the webcast, please submit via the question box. We'll try to answer all questions during the webcast today, but if a fuller answer is needed or we run out of time, we can answer that later via email. A PDF of the presentation is available in the program materials folder. This program has been approved for legal education hours. For live attendees, you can report your hours by clicking on the CEU icon at the bottom of the screen. A certificate of attendance, including course numbers, will be emailed to you tomorrow, along with a recording of the webcast for watching and sharing. We will have a recording of this webcast available. It typically takes about 24 hours to render, after which time you're welcome to it if you'd like to get a copy. Toward the end of the program, please be sure to complete our short survey. We use your feedback to plan future programs that apply to your business needs. That's all for the housekeeping items, so let's get started with our program. Today, we're going to address the legal and also risk management and insurance steps necessary to successfully develop a biogas project. Specifically, we're going to pay attention to the insurance risk management and legal steps that are useful and beneficial in the early phases of biogas project development. So joining me today are Watson Barker. Watson has been dedicated to the design, marketing, implementation, and service of energy risk management and insurance programs since about 2005. His oil and gas experience includes conventional and unconventional E&P, midstream, and also OFS operations in shale basins across the country, and various onshore and offshore UK and AU fields abroad. Watson has worked extensively with public E&P and PE-backed management teams, representing more than $4 billion of investments to equip, guide, and protect strategic plan execution. His renewable energy experience includes biogas and RNG facilities across the United States. Practice areas are focused on equipping management teams to navigate the interplay between OEM, PPA, lender, and EPC agreements, as well as customized asset protection for multi-project and multi-phase development plans. In the last 12 months, Watson has supported management teams representing in excess of more than $500 million in capital investment. Also from IMA is Kenny Hallisey. Kenny has been with IMA since 2016 as Vice President of Renewables, where IMI now insures more than $14 billion in total insured value out of renewable development. Kenny's portfolio includes renewable natural gas, ethanol, biodiesel, renewable diesel, solar, wind, battery storage, and hydrogen organizations. He works extensively with public, private, and private equity-backed companies and has an extensive knowledge in LCFS 45Q, carbon sequestration, carbon offsets, and also niche captive insurance programs. Rob Battenfield joins us as well from the IMA side. He's got over 20 years of experience in the insurance industry. Rob currently leads the energy property group from Amwins. Rob has worked with some of the most complex specialty chemicals, biofuels, renewable, and power generation sectors risk in North America. And joining us from the Husch Blackwell side is David Gardells, my colleague, an accomplished transactional lawyer. David is a trusted advisor as companies pursue growth, acquisitions, mergers, or dispositions. His emphasis is on renewable energy, especially ethanol, biodiesel, renewable natural gas, and wind. David represents investment bankers, developers, and owners of renewable energy projects, providing specific counsel that meshes with their business direction. So without further ado, I thank you all for being here, for your time, panelists. I thank you for your time as well, and I'm going to turn it over to the IMA team.
Thanks, Andrew. Had I known you were going to read my bio, I would have certainly shortened that for the sake of this audience. That or possibly added more acronyms to make myself appear smarter. But I'm only as smart as my colleagues here because I love to attach myself to folks that do that make us shine. And I'll just say on behalf of Kenny and Rob, we're just thankful to be invited to this webinar today. And we're also just really thankful to have been invited to participate with management teams out there in helping them steward their investment and execute on some really exciting projects across the renewable space. We've been at it for a long time, from kind of early days in ethanol, and kind of been enjoying the ride as this sector has evolved into biodiesel, ethanol, and RNG, and now carbon sequestration. But for today's talk and purposes, we'll focus on our efforts in the kind of RNG and biogas space. Did you want to go through, Andrew, this initial questionnaire or polling question, or shall I do this?
Sure. You'll see audience members as we scroll through slides from time to time. Poll questions will appear. These are poll questions, and feel free to submit answers by just clicking the box that best describes you. Our program is going to calculate results, and then as we scroll through slides, you'll see results presented to you. So Watson, feel free to give it a second while people click buttons, and then carry on.
Sure. So question here, what best describes your role in biogas projects? We had a hunch that there may be a variety of, essentially folks that are landing in various stages of development or on the continuum of project development. So our hope is our comments today will be applicable no matter where you fall. But, a few more seconds here and we'll figure out what we got. Okay. The overwhelming majority here is in 101 arena, but we do have others that find themselves in the financing arm, or capital sourcing via private equity, or the folks that are actually going to execute the project. So capital providers, developers, and other. So, all right, well, we'll take note of that as we proceed. Thank you. So just before we dive into kind of some of these specific initial assessment points, I think broadly as a team from the risk management brokerage arm, and kind of sitting at the table as we evaluate what sits before you and how you're going to navigate it, we think of a couple of prevailing kind of initiatives. One, we want to equip the management team before us to help execute their goals and priorities and objectives. We do that by thinking long-term. We don't necessarily just think about the immediate opportunity or the immediate project before us, but what is the portfolio to look like? Are we looking to develop and exit? Are we looking to develop, own, and operate? Are we doing this portfolio in a certain geographic area? Are we doing this domestically, more broadly, internationally? So we want to take stock of all of those things to help equip management teams well. The second thing we will look at is allocating risk transfer capital effectively. We appreciate that this is a notable investment that you make, and consequently we want to do it well, and principally we want to align that capital outflow to the exposure ramp and the balance sheet sensitivity. So as you bring on new projects online, or you acquire them as technology may evolve, we want to be sure that the insurance program will properly reflect those things, as well as your balance sheet can sustain more risk, then we want to essentially modify the insurance program to acknowledge such things. Kenny, Rob, anything from a prevailing standpoint that you think of out of the gate, just for the audience's benefit? If not, I'll keep going.
Yeah, go ahead, keep going. We'll get there.
Okay. So just the initial assessments, guys, these are all the things you see here are influential factors to to a placement. And so just to quickly make a short comment on each, project size and scope. Look, physical damage and business interruption or cash flow backstop, that aspect of the insurance program will capture the largest amount of premium, and the total insured value will dictate kind of our market selection, how we structure the program, be it 100% to a single carrier or quota share option, for example. The timeline, we need to consider whether it's a single project or are we going to be engaging with multi-phase, multi-projects. The application is indicative of, if we've got an immediate off-taker on location with an RNG facility versus putting it on a pipeline or a transmission line to an end user somewhere else far away. That can tell us a little bit about the infrastructure that is going to be a part of the project or projects. Asset technology profile, this is really key, and principally because the market will be keen to know if it's a proven technology or a prototype. Naturally, proven is better than a prototype. Contracts, we'll go over that on the next slide, but we have outlined essentially 5 that we see most often, and we'll talk about that, like I said. M&A, what are we asking the program to potentially accommodate? Do we have things on the horizon that may offer us immediate cash flow to support the development, while we're getting things built, developed, and turned online? So we need to kind of think about those things. We're going to be opportunistic, or do we have things immediately on the horizon? Environmental review, of course, phase 1s will be the things that we look at most readily. Capital sources and uses. This plays into things like directors and officers liability. If you have intentions of going public, do you need things like roadshow coverage in advance of that? Of course, there are compliance considerations with regards to your stakeholders. And so that's why we want to understand how you are going to fund the project. And lastly, tax incentives. So things like LCFS or RECs, which we call renewable energy certs. Do we have to structure a program that will contemplate the fact, the lift that these tax incentives can provide to the pro forma? So we look to incorporate that into our programs. We mentioned the fact that we consider contracts that would be highly influential. Suffice to say, insurance always follows a contract review. The contracts will dictate essentially and the first thing we're looking at when we look at the contracts is that risk transfer scheme, what we're downloading to our own balance sheet and what we can transfer to other parties, be it landowners, be it contractors, etc. But we have 5 contracts here: the lease agreement, lender agreement, PPA, as may be applicable depending on the types of assets, the OEM, and the EPC, equipment procurement construction contractor, those that are helping construct the plants. In addition to the risk transfer scheme, we are evaluating what compliance obligations we might have with respects to these counterparties in the contract. We are looking at the insurance provisions within these contracts and specifically the commercial reasonableness of those insurance provisions. We want to be sure that, naturally a lender is oftentimes the one that is putting forward insurance requirements, and we just want to be sure that those are right-sized based on the type of project, scope, and scale, and that they're commercially available. We're also looking at how to integrate certain aspects of these contracts into our insurance program, and that would be specifically the OEM agreement and the EPC. The OEM would be things like warranties with regard to critical equipment, or long-term service agreements that go along with that OEM to help with maintenance and overhauls and things that are recommended by that OEM on a go-forward basis. And then the EPC, oftentimes we're evaluating who is going to take the builder's risk coverage, meaning the cover for the assets while being constructed, installed, tested, and commissioned. certain, just a quick comment on EPC contracts, and it can be thought, sometimes the school of thought is that we would prefer that the EPC bring the builder's risk because it's a less expensive avenue to address that form of coverage. That is accurate to a certain degree and can be appropriate for certain projects. Our team might argue to say that we would probably not look to go that route just to exercise more control over the process. All right, Rob, you want to take this next one on placement best practices?
Yeah. And just to kind of piggyback on Watson's comment on control of builder's risk, when we start talking about delay in startup coverage, which is your business interruption coverage for construction projects, you start to think about incorporating RINs, RECs, and LCFS into that methodology in that insurance contract, and you start to think, well, the EPC contractor has no insurable interest in that part of the claim, and they're the first named insured who's responsible for negotiating those claims. So it's just something to be aware of and to be mindful of, and those claims are always tricky. You don't want to add an additional layer of complexity into that stream of negotiation by having your contractor be the one who has to negotiate your business interruption claim. So that's just something to be mindful of. Best practices, it's critical to adhere to to equipment management with the most fit for purpose insurance program. So best available terms and conditions, right? How do we get that, and what does that mean? So the way that we see these projects all the time, and early engagement on construction projects is the primary objective, right? The quicker you can get a trusted insurance broker engaged, the more flexibility you're going to have in transferring the correct amount of risk into the insurance market. And Watson's already touched a little bit about those, on the contracts. Those contracts are going to narrow you in. So when procurement signing contracts, if you have an insurance broker who knows what's commercially available, those sort of minimum deductibles required or maximum deductibles required in each of those contracts down the road can cost you significant money, right? So when you start to see insurance premiums come together for builder's risk, and I've seen it happen, you sign a power purchase agreement 2 years before you get the builder's risk insurance placement put together. You may see somebody in procurement sign something that said your maximum deductible is $10,000, and then the commercially available deductible is $200,000. And you, as the insured, say, well, we could take a retention of $500,000 to save, $1 million in premium, right? But because procurement signed that contract 2 years ago that says the maximum deductible allowed is $5,000 or $10,000, that's what you're stuck with. So those are little things that can go a long way and avoid a lot of headache of going back and trying to get a waiver on a contract or have a contract renegotiated. A lot of times it's just too late. So you get stuck with having to pay premium for 1, 2, 3, 5, 10 years because of a contract that exists. So, like Watson said, a little goes a long way with these things. Technical brokerage, having someone who understands the risk, has relationships with the underwriters, and really can go through the forms or the insurance contracts that are being issued by the carriers and make small modifications to those wordings can go a long way when it comes to a claim. Having a named adjuster assigned who's familiar with your risk, right? And you don't want an adjuster who's adjusting first party homeowners claims assigned to your risk, right? You want someone who's done an RNG claim, a builder's risk claim, and then even a technical delay in startup claim that includes LCFS, right? You want somebody who's really technically sound and available. You want that to be named on your policy. It's a simple thing that goes a long way. Integrate risk control and engineering. We're going to cover that in the next slide, and then reflect the 3 to 5 year plan. Multi-project, multi-phase is your is your program going to grow, right? Are you going to build multiple sites? Are they going to be all on the Gulf Coast where they're exposed to an windstorm, or are they all going to be in the Midwest, right? To where there's maybe some tornado exposure or flood exposure. So those are things to be aware of as you build a plan, and then have a platform of insurance, which is a suite that can grow with you as you continue to grow. So we could kind of move on to the next slide and get into more early engagement, right? So early engagement services, again, a little goes a long way, right? So we see so many of these projects coming to us late in the game and saying, can you place our insurances, right? And the answer is always yes. But how difficult and costly will that be? Fire protection and loss control, right? Upfront incorporation of simple fire protection measures, saves a ton of money, reducing the amount of capital transferred into the insurance market over the entire lifespan of a project, right? So if you're building something, right, and you want to add some of these small things in, like auto venting, if compressors are inside, right? Building your compressors inside is not a bad thing, but not having auto venting for gas detection is something that insurers want to see. And retrofitting the facility, especially if you've got concrete walls and things like that, could be very costly. But it may be, we've seen stuff that's a $25,000 modification change order that turns out to be like a $2 million project after the fact, that maybe the difference in having the cheapest insurer come to the table and offer terms. So there's three big examples that we put on here. LEL detection, which is lower explosive limit gas detection, which shuts down the entire system if that explosive limit of gas is detected. Auto venting, right, if compressors are inside. And then UVIR detection with full automatic shutdown. So it really is some simple things, and you can go out and look at what building this up front or retrofitting costs. It really does make the difference of moving from an opportunistic insurer who's just saying, we're fine insuring a very risky venture, or going to a technical insurer who wants to see loss control engineering and maybe go out and see the facility and says, we believe this is an above grade risk. We're going to give you a very low price because we think the risk is low. We've taken that from a technical perspective. So that's really, we do a lot of work on this, and we see it every day, but you'd be quite surprised in seeing how the right advisor hasn't been in there to make sure that these small modifications are made over time. So it could save, money over the entire lifespan of the project. And that's really it on this one, Watson.
Okay, nice. So, all right. Well, we just wanted to offer up just a quick example of kind of this technical brokerage and integrating risk control and engineering. We had an RNG developer looking to make an acquisition of some gas rights, and on that lease or on that piece of land were some existing, in that acquisition, they were going to obtain certain power generation assets as well that were operational. But there are two challenges to this. One was the asset type. Look, this is an RNG developer primarily looking to get these gas rights to develop RNG infrastructure, but they, at the same time, didn't want to just abandon these power generation assets that were yielding cash flow. But they were dealing with an LM6000 gas turbine, which does not carry a very good reputation in the marketplace. And it was going to prove very difficult to get placed, especially in the light of the fact that it had not undergone its required OEM overhauls and maintenance. In addition, the RNG developer wanted to go in to some of the existing plant infrastructure and retrofit it with their technology. And then they were going to have to test and commission all of these things. So with the asset types, with the kind of quasi-construction project that they were having to kind of drop in the middle of an operational facility, where would you insure this project or this acquisition. And for those, Rob, Ken, and I would say the best place to do this would be within an existing operational policy, if we can make it happen, just given the overall scope of coverages and costs. So we took upon ourselves 3 steps to get this done. First, we engaged the client, and we engaged IMA's risk control team and engineering team to go in to the plant with the plant engineers to do an initial assessment of the scope of the risks inherent to what they were going to do in the retrofit, and also to develop a comprehensive risk mitigation plan specifically as respects to the turbine. We then developed a clear outline of the scale and scope of this overhaul project, because essentially the project budget will dictate whether this can fall into an operational policy or will get kicked over into a builder's risk policy. And if we can classify it as incidental to the operations, then oftentimes we can drop it into a property program. And the third step was to engage the market, to engage the carriers and the underwriters and their risk control teams, to invite them to the plant to where we could do a presentation on all of these things and to get them on board with the plan. So the outcome of this was that we were able to get this project and acquisition folded into an operational policy, saving the client around 6 figures. All right, Kenny, talk to us about tax credits and guarantees.
Yeah. A couple quick comments. Early engagement. So one, on the builder risk standpoint, I just wanted to point out how important it is for the owner to carry the builder's risk for a number of reasons, to include what Watson and Rob said, but a couple more just to help drill that point down. Is there's a limited carrier marketplace on the property side. There is not on the builder's risk side. And there oftentimes can be gaps in coverage between those two. And so we try to have the same carrier on the builder's risk as well as the operation to make sure there's no issues in the event of a claim. The other point I was going to say is that coming from the EPC side of the house, I know if we ever put a builder's risk down, we typically were putting 10 to 20% margin on there. So there's better efficiencies as well as cost savings and the insurance of being the first on the list in the event of a claim. Another piece real quick I was going to touch on is on the design phase. It might even make sense to get your broker involved from the design and engineering standpoint to ensure that it is built to spec to where you're not paying for it on the back end within your insurance spend. But now the items I was volunteered to talk about are business income, tax credits, and then briefly performance guarantee. And I'll be real quick so that Husch Blackwell can say their piece. So first off, on business income, it's included in your property insurance. It usually has a significant higher rate than your property insurance, but it's covered under the same policy. So what's included in BI or business insurance, as a rule of thumb, it often reflects your EBITDA, which would include the likes of LCFS, RINs, as that's about, probably 90% of the revenue in the RNG arena. And then with more states coming on board, obviously LCFS is going to have a bigger and bigger piece of the overall revenue, ideally. The other piece, carbon capture. So with RNG facilities releasing significant CO2, it surprised me a little bit last year that we weren't talking about carbon capture a little more in this world. We definitely were in the ethanol arena, and that continues. And the RNG arena, they're definitely talking about it now. I don't know of any that are looking at sequestering at this point, but there's obviously a financial benefit to doing so. The benefits come by way of a tax credit called 45Q, which I'm sure everyone is familiar with, either through EOR, which I can't imagine being real popular in this industry, utilization, going in POP or whatever, and then the highest benefit being in sequestration. We've seen it, like I said, in the ethanol industry with either you owning and operating the sequestration equipment, or by way of a land lease, and just about everything in between as far as contracts. So I see a lot of the RNG industry potentially reaping the benefits by selling to a renewable fuel operation, if there's one in the area, whereas it would reduce their CI score and obviously increase their 45Q earnings. So you might get more of a premium there. From an insurance standpoint, there's actually a 45Q insurance product. The last time I checked it, it was about 6 to 8% of covered value. And what that does is it basically ensures that your credits are invalidated. If they are invalidated, you don't have to pay them back for the 3-year clawback period. And then the last thing I'll say before passing it to Husch Blackwell here, performance guarantee. I definitely don't want to spend a lot of time on this, but it's a popular topic. But I want everyone to know there is a product out there, typically that it involves a ton of pre-engineering, upfront work. It's very expensive, but to the right project that's not getting off the ground due to financing or needs improved interest rates dramatically, there's potential for this product. It can put floors in place on your LCFS RINs, 45Q, MMBTU, offtake. Just know that it's out there, but there's a lot of time, a lot of effort, depending on the complexity and newness of the technology, and it can be very expensive. So thanks. I'll pass it off to, Watson, you've got one more, it looks like, before Husch.
10 seconds on this, guys. Just which one do you be aware? A lot of you guys are aware, but this, reps and warranties insurance is growing more and more popular as a means to help facilitate transactions. Effectively, it can be the buyer and seller's sole remedy in the event of a breach of a rep or a warranty within the MIPSA, and that's managing interest purchase sale agreement. And then, it avoids any kind of cash held back in escrow at time of close, which makes it a whole cash deal, which people love. So they're just investing in this product. Happy to talk to everybody a little bit more about it. But I can just say that, it by and large for deal sizes 50 million and up, it can go as low as 25 to where it still has some economic benefit. Andrew, all yours, sir.
Thanks, Watson. Appreciate it. IMA team, thanks a lot. Very, very useful, and thank you for your time. We wanted to structure our part of this presentation as sort of first steps. What are the things specifically that developers are going to do to set the table for a successful biogas project development? And biogas sort of writ large, whether that's a dairy project, a landfill project, a hog or swine project, or really any other sort of digestion or wastewater project. What is it? What are the legal elements all of these projects share that are best to get squared away early in the game, and you can save yourself a lot of grief on the back end? So the first one of those things are your contract rights. What are the necessary rights that you need to get in place to be able to bring your team in to develop a biogas project successfully? The one that sort of makes everything work starts with your real estate rights. What is it that lets you be on the site where you're going to develop your project? What lets you get your contractors and third parties on that site? What lets you access that site, store things on that site as you need to? That's typically going to be a lease or a license. Those words are often interchangeable depending on whether you're dealing with a private landlord or maybe even a public entity. You might call it a lease or a license. And then an easement, which sort of fills in the gaps between what your lease or your license doesn't quite cover. You need a feedstock agreement in the landfill arena. This obviously is going to be municipal solid waste. In a digester arena, this is going to be essentially manure. In any sort of other digester project, this is going to be either your sludge or whatever it is that is going to interact with the bugs and decompose and make the gas. So in a feedstock agreement, some of the things that you want to get buttoned down early in the game are going to be your quantity, how much feedstock it is that you're entitled to and how often you're going to get it, the quality of that feedstock, make sure it meets spec to go into your digester and to make gas that can go into a pipe, your term, how long you're going to get this feedstock for, and the price. What is this going to cost you? Is it going to increase? Is there an inflation kicker over the years? Is there some sort of renegotiation at the end of the term? And then cover options. If your feedstock supplier fails to provide what it's required to, what can you do to fix that shortfall? Who's going to pay for it? And are there some liquidated damages that are sort of going to be your hammer in the event that your feedstock is late getting to you, doesn't get to you all the way, or doesn't get to you in the sort of quality that it's supposed to? These things, by the way, not only are kind of the keys to a successful project going forward, but they're the things that make your project financeable. The lenders and investors in this space are just increasingly sophisticated by the day, and their diligence on any loan, any investment, any equity involvement is going to more often than not involve crawling through your feedstock agreements, crawling through your leases, and making sure that feedstock agreement has liquidated damages, has cover options to make sure that you can enforce performance, and make sure that it matches up with your real estate agreements in terms of term. Right? You don't want your lease to expire while you still got 5 years left in your feedstock agreement, or vice versa. These things should mirror one another. Your interconnection agreement is sort of the last kind of critical real estate agreement to fall into place. And that's the one that lets you take your product gas and actually put it into somebody's pipeline and get it to market. So tips for successful development: look at the assignment clauses in these things. That's language that's often overlooked because it tends to be boilerplate, and it's sort of stuck in there with, your governing law and the rest of kind of your boring provisions. But when you go to transact a project, buy it, sell it, merge, assign, put it into a portfolio that's going to be transacted, those assignment clauses become important. You don't want to go to your host dairy or your host landfill or whatever it might be and say, listen, it turns out I need your prior written consent to assign this. And that landlord says, sure, that'll be $100,000. So look for easy assignability. The other tip: try to get terms that line up, try to get lengths, including renewal terms, including extensions that mirror one another. Again, so that you have the right to be on this land through a lease, a license, an easement for the same amount of time as you have a right to develop a project, as you have a right to receive feedstock. It doesn't make sense to be able to do those things for different periods. So once you've got your contracts in place and you've sort of set the table for successful development, you need someone to come help you do the developing. So what are the primary contracts that you're probably going to be looking to outsource to service providers? And this is after you've gone through sort of front-end engineering and design, and probably environmental studies and real estate surveys. And so here you are on the ground, you have your rights, you have your feedstock rights, you have your real estate rights, and now you need the experts to come in and start working with you. We approach these the same way as we approach the other contracts, which is, how can we make these things the most financeable and on the best terms, and make the money the cheapest for our clients? So the first type of contract we'll look at is the EPC agreement. This is the engineering, procurement, construction agreement. This essentially is the agreement with your general contractor. What financing parties look for, and what, and Watson IMA folks, correct me if I'm wrong, but what insurance carriers and what the insurance market is more and more looking for, is a full wrap guarantee. You want some third party with its own insurance or a strong balance sheet or deep pockets to stand behind their work. You want that EPC contractor really to guarantee this bumper to bumper to warrant your project. Touching on that, but separate, is an uptime and performance guarantee. Financing parties, insurance providers, are looking for EPC contractors who are going to say, look, the plant that I'm building for you is going to work this % of the time, and it's going to be this % efficient. And if you get those guarantees, what you're usually going to get along with them is some form of liquidated damage, which again is your hammer to make sure those guarantees are stood behind. So that if this plant goes down, if it misses its uptime guarantee, if it's turning out gas that's 85% X instead of 95% X, this is the thing that earns you money per day out of the pocket of that EPC contractor. So you've got some leverage to say, listen, fix it. Because for every day that that plant's not working in the way it ought to be, that's really money coming out of your pocket. And you care about that, sure. Your investors care about that. Your lenders care about that. And all of your downstream partners care about that. Think about your offtake partners. not only are you failing to make gas, but when you fail to make gas, you sort of trigger a domino effect downstream with your offtake partner who says, well, now you're not delivering gas to me. And you'd like to not be able to not have to come up with that money out of pocket. So again, you're looking to your EPC contractor, you're looking to performance guarantees, you're looking to uptime guarantees. When the EPC phase of your project is over, everything has been engineered, procured, and constructed. You've hit the button, the plant is turned on, and you've hit COD. Congratulations, break a bottle of champagne over it, and now the O&M agreement takes over. The O&M agreement, operations and management, is going to be typically with a third party. There was a time where Bob's Biogas Development LLC could farm out EPC and farm out O&M to Bob's EPC LLC. And then, Fred's O&M, and Fred happens to be Bob's brother-in-law. Those days are on their way out. For EPC work especially, and it's getting to be that way for O&M work as well. We see some leeway still that affiliates can retain one another to do O&M services. And that's often a strategy for developers to sort of secure a recurring source of revenue to themselves in a development. If they get into it with a strategic investor, that the developer is going to hang around, or an affiliate of the developer will hang around and provide the O&M work. Even so, the best financing terms, the best coverage terms are going to look for a reputable third party. And one, again, with deep pockets, strong balance sheet, or its own insurance coverage, or all of the above. Again, a third party O&M that really knows what it's doing is a way to de-risk the project. It's a way to help that project meet the uptime and meet the performance guarantees, because it's being taken care of. Watson mentioned that LM6000 that hadn't gone through its OEM recommended overhaul. Goodness, this is the person who makes sure that doesn't happen. And if that does happen, this is the neck to squeeze to get it fixed. And again, you might be looking for liquidated damages to make them stand behind those guarantees. So another tip here, working with third parties, look for transferable warranties. Warranties are another thing that often sort of gets stuck down in the boilerplate of a contract. People look for who's going to do what, when are you going to do it, and what's it going to cost. And then down in that miscellaneous provisions that might run another 510 pages about your governing law and no inconsistency being construed against either party. Stuck down in there tends to be helpful stuff. One of those helpful things is transferability of warranties. If you've got a project and there's a third-party O&M provider involved, and there's a third-party EPC provider involved, and they're giving guarantees to you as a developer or to you as a financing party, they're not necessarily giving those guarantees to the project. So when the project changes hands to some third, or by now in the example, maybe fourth party, those warranties don't necessarily transfer. It's almost like a roofing guy who does work on your house and he warrants to you that your roof is great and you sell the house, and that warranty doesn't necessarily protect the new buyer if it doesn't transfer with the house. So it's a simple sentence: look for warranties being assignable or transferable. So now that you've got your rights together, now that you've got your contracts in place, you're ready to go out and look for money. You've got a good deal put together. You've got sort of a good package to present. You've got an easement. You've got a lease. You've got a license that lets you be on the land. You've got an easement that lets you, work there. You've got a feedstock agreement that lets you get what you're going to make gas out of. You've got these third-party guarantees where some reputable party is going to help you build this project and help you run it. So time to go to the bank, time to go to the investors, time to go to the lenders, and look at the ways in which you can get money, the ways in which you can get development capital, ways in which you can structure that money. And so what we used to see was projects getting developed and developers looking for development money project by project. This is sort of traditional project finance. I've got an idea, give me some money, I'm going to build the idea, I'll return a rate to you or an interest to you. And more, we've seen biogas evolve in the same way that wind and solar evolved, which is that these projects got to be so proven and so non-prototypical and so profitable that they didn't have to be done one-off. It made sense to bundle them and develop them and finance them in portfolios and transact them in portfolios. So, probably not quite gone, but at least halfway out the door are the days in which somebody wants to buy your single RNG project. Maybe it's a giant one and they really do, or it's got some great gas rights and you really want those rights, or it's with, really an investment grade counterparty and you want that counterparty's name. But more often, people are going to be looking at buying 3, 4, 5, 10 projects instead of one. And we'll talk about that in a minute and why, that's becoming the trend. So project finance is sort of the traditional way. Here's a project and here's some development capital. What we see in our practice more and more is financing through joint ventures, in which case there's an equity partner coming in with the developer. And that equity partner is typically sort of falling into one of three categories. There's a strategic partner, somebody in the industry who wants to be further involved, who wants to secure a green gas supply, who wants to be involved in the economics of the industry. There's sort of an agnostic but economic-minded investor who really, biogas is the same as, whatever other sort of investment there is, but they like the returns, they like the economics, they like the industry. And then the third type is really an ESG-motivated investor who likes the green energy angle and wants to be involved in that industry. So we see them coming in typically through joint ventures. We'll talk more about that in a minute. Debt finance, your typical lending, be it secured, unsecured, senior, subordinated, mezzanine, or however else it might be structured. We see tax equity finance. That might be sort of changing and improving depending on what comes out of Washington at some point, between now and the end of times. And then the sort of old standby bond issuances. So without further ado, let's touch on why these things are starting to go and get financed at a portfolio level instead of a project level. One, really, it's sort of economies of scale in terms of cost, but also in terms of effort and in terms of time for both lenders and developers, or investors and developers. On the lender side, the investor side, and I say lender, but I should say investor as well, the financing party side, this simplifies underwriting. You look at a lot of projects instead of one, you can de-risk your investment, you can spread risk across a portfolio, you're not putting all your eggs in one basket, so to speak, and you deploy capital faster. If you've got an amount of money you want to get out there in the marketplace working for you, you can do it in a portfolio, you can do it sort of with a single developer, but a number of projects, and get that cash out there working faster. For developers, you get capitalized faster with more efficiency and more discretion. In typical project finance, your financing is going to be tied to a very specific project with a very specific fence around it. And that financing shall not bleed beyond that fence. At a portfolio level finance, you often have got a little bit more discretion where it is you can put your money. Simplifies underwriting. You're presenting one portfolio to get approved as opposed to project by project by project. You present a more attractive de-risked investment. You can develop projects sort of parallel paths, same time, which means more of these things hit COD and get turned on around the same time, instead of one hit COD, then the other hit COD, then the third hit COD. If you get the whole pot financed at once and you develop them sort of starting at the finish line when the same gun goes off, they hit COD, not at the same time because there are project-specific differences across the board, but closer in time. So you're going to have a portfolio that returns more revenue faster. And then, of course, finally, you've put together a portfolio that's attractive to bigger, better, stronger investors, buyers, other investors, other developers. You've got a portfolio now that makes a more attractive investment than a single project because it's returning more money and because there's no single point of failure in a portfolio. Again, all the eggs aren't in one basket. So now you've got an idea of why it is that you probably want to finance, if you can, a portfolio of projects as opposed to one, which isn't to say you'll always do that, but more often than not, that's the direction we see things going. So how are you going to do that? The way that I mentioned a bit ago was through a joint venture. This, I think, is a great tool. Our practice sees joint ventures becoming, more and more common day by day. It aligns interests between developers and investors. Everyone sinks or swims together. The risk is allocated, returns are allocated based on how much skin each party has in the game. But this is not like a bank loan in which the bank says, look, your project might be struck by lightning and burned to the ground. We'd like to have our interest, please. in the joint venture, parties are incentivized to work together for the common good. It also vertically integrates projects. I mentioned strategic investors, people who are big players in the industry. Think of, a party like Total or Clean, Element Markets, a dispensing party, a marketing party, gas transporter, gas marketer, teaming up with a developer or an obligated party under the RFS program. Somebody like a Shell, Chevron, BP, Marathon, those sort of folks who want to lock in that supply of renewable gas because they need it in order to hit their renewable volume obligations, because they're obligated parties under the RFS or under the LCFS or a state equivalent. And so what they want to do is lock in volume, and they'll pay for that. And developers, of course, want to be paid, and they want to provide that volume. And perhaps there's a marketer or a transporter involved there as well. More and more, we're seeing utilities, from sort of big statewide utilities to smaller regional utilities, get involved as investors in JV projects. I think that they have some ESG goals in mind. I think they like the economics, but I think they're also looking to places like Canada and some states, and they see the writing on the wall that they're going to, at some point and sooner rather than later, be obligated to put X percent of green gas in their pipes, and they want to lock it in now, and they want to lock in a price now. So you see JVs vertically integrating projects between participants. And of course, JVs allocate risk and reward. You put in a lot of money, you take a lot of risk, but you also get a lot of reward. You might be a developer, and what you're putting in is, so-called sweat equity. And this is a way for you to get some carry based on that sweat equity and scale up your project, although you might not necessarily have the money in your own pocket right just then to do it. So that's essentially joint ventures 101. Debt finance is sort of the traditional lending model. Your debt's going to be either senior or subordinated. Subordinated, obviously, taking a backseat to senior in terms of distribution priority, in terms of security and foreclosure priority. This debt typically is going to be secured. It's going to be secured by the revenue and the assets of your project. And this debt, more and more we're seeing, is coming from agriculture or even specifically biogas-focused lenders. These are the folks who really understand the market. They've been loaning to farmers. They've been loaning to developers for some time. They're really specialized green lenders. Their money is going to be a lesser cost than subordinated debt because it's got a higher priority. And so giving up that, that interest is what they get in exchange for the protection of that priority. The subordinated debt is not going to have that protection, and so they're going to charge some additional interest to make up for being the unsecured party, or rather not unsecured, but the more junior party. And this debt often comes through USDA guaranteed bank debt. The USDA guarantees under some parameters biogas developments, and so that makes the money cheaper. And you work with a USDA backed bank, and they know the process, and so they're going to be able to sort of navigate things like a farm's balance sheet. When the bank says, well, let me see your host dairy's balance sheet. And they look and they say, well, these guys are leveraged to the ears and they don't show any revenue. And the farmer says, wink, I know. And these banks say, okay, we understand. As opposed to, a larger commercial bank that's going to say, this just isn't our area and we don't understand the economics here. So the sub-debt, subordinated debt, is effectively what you might call mezzanine debt. It sort of acts as almost equity to senior debt because it's taking that risk of not being secured. For that reason, it's going to be a higher cost. And it might come in the form of bonds, which we'll talk about in a minute here. So in addition to traditional lending, we see tax equity and tax equity lending playing part in the capital stack to get projects built. This was really common in wind and solar deals, and it worked so well there that, of course, the biogas folks said, well, great idea, we're going to borrow that. And so it's becoming increasingly proven out in RNG applications. And what it does is provide a strip of capital that's not debt, nor is it traditional equity. But you've got to have some qualifying investment tax credit property to get it, what we call ITC property. So you've got to take part of your project or part of your project components, something that qualifies to get an investment tax credit. Hint, electricity, native electricity load, the thing that makes electric that powers your projects. You don't have to buy it from the grid, ITC. Carve that off of your project, submit it and qualify it for ITC, and that will come back to you, that ITC qualified element, in the form of a refund. Now, there's something in the works to make this a direct pay credit, or to make it essentially a refund on overpayment. Obviously, if you get back some sort of tax credit and you are a pre-revenue enterprise and you don't have tax liability, that credit is not going to be worth a whole heck of a lot to you, and you're going to sell it to somebody at a discount, and that's traditional tax equity financing. If things could be restructured so that credit were counted as a refund on overpayment, that would put money directly in your pocket. You could capture the entire value and not have to sell it to somebody at a discount. But, watch Washington and stay tuned. We'll see if that happens. So at this point, let me pause and make sure that everyone is still awake and ask the question, what are some advantages to developing portfolios of projects? And if you've been paying attention for the last 45 seconds, this ought to be a no-brainer. So we'll give this a couple seconds and see what answers come in. And I think that if I advance this slide, I'm going to see answers, perhaps. We'll see if it worked. Hey, sure enough, all of the above, and 0 people answered the rest of it. So either everyone is, smarter than I am and knew this already, or you were paying attention, or, if you're Kenny out there, you probably called up Watson and said, hey, what are you answering? Which is the Zoom equivalent of looking over your neighbor's paper during high school. So let me ask you one more question, and then we'll move on. I think this might be our final question. What types of financing parties are interested in joint ventures? And we'll give it a second for answers to come in. Kenny, the answer is D. There it is, 100%. Answer is D, so A's all around. So that brings us up toward the final part that we're going to talk about. One of the ways that money comes into these projects, and it's really sort of a specialized way and a little bit more technical than the rest because it's more regulated, and that is through bonds. So at this point, I'm going to turn things over to David Gardels, who is another attorney with our firm, Husch Blackwell. David's experience is traditional oil and gas, and from that, he became an ethanol attorney. And then as an ethanol attorney, David really sort of saw the start of the biogas industry, and that practice shared a lot of traits with ethanol. And so David runs our biogas, biomass, and renewable natural gas groups over here at Husch, and he has a particular expertise in all things having to do with bonds. So without further ado, let me turn things over to David Gardels.
Hi, well, thanks, Andrew and IMA team for your good work and a great presentation. So with just a couple of minutes left, I'm going to cover really the high points here. And the first is that you all read about these, everything green funds, green bond funds. And so there's a lot of market demand right now for green bonds that are both taxable and tax exempt. And a taxable green bond is just another form of secured financing, but it has a bond trustee and all the looks of a bond issue, and the bonds have CUSIP numbers on them and all those things. So that's a taxable bond. But also there's the opportunity to do municipal bonds, and there is a category of bonds that was set up many years ago for solid waste disposal to allow municipalities to facilitate, disposal of solid waste. So even though our cow manure's got a lot of liquid in it, it counts as a solid waste, and the same with the other categories of agricultural waste. So every state has an allocation of how the quantity of tax exempt private purpose bonds they can do. So the first step, find out if there's capacity in your state and work through that process. But it's essentially, there's a bond trustee, a municipality has to work along with you. They get a small fee for doing that and issuing the bonds, which are tax exempt, but only the project has liability. So there's a few more points on that, but as we're coming to the top of the hour, I just want to, and again, the thing that's driving this right now is the, demand for green bonds. And also, not 100% of a facility can normally be financed with municipal bonds. So you can do a side-by-side issue of, Series A is tax exempt and Series B is taxable. So you've got the whole structure in place, but with both elements. So that's that slide. And I've mentioned the exempt facility. And I think I kind of covered that. So, it is another financing technique which has a lot of parties to it. The underwriter, there'll be underwriters counsel, there'll be a counsel to the people who actually buy the bonds. So there's quite a bit of project expense, and the trade-off comes, of course, with a lower rate. And going into this, inflationary cycle that we're in, I'm anticipating there'll be more demand for using tax-exempt bonds in our projects. So we're 101, finishing on time. So I really appreciate the IMA folks. And even though I've worked with you guys for a long time, I learned quite a few things today. And Andrew, do you have any closing remarks?
Yeah, thank you, David. And thank you all for joining us today. We hope the information was helpful to you and your organization. As a reminder, this program has been approved for legal education hours. To report your hours, click on the CEU icon at the bottom of the screen. A certificate of attendance, including course numbers, will be emailed to you tomorrow, along with the recording of the webcast for watching and sharing. Be sure to complete our short survey. We use your feedback to plan future programs that apply to your business needs. And of course, you see all of our contact information directly on the screen in front of you. So if you have any follow-up question or anything you'd like to talk about that we didn't touch on today, please feel free to get in touch. We'd love to hear from you. Thank you all very much. And that concludes our presentation.
Thanks.
Thank you.